Right now, Silicon Valley is just pouring trillions of dollars into AI chips, server farms, and, advanced code.
Oh, absolutely. The scale is unprecedented.
Yeah, we are basically in the middle of the most explosive artificial intelligence boom in history.
Right.
But one of the most famous forward-thinking tech investors in the world just looked at that boom, dumped an enormous stockpile of Nvidia stock, and bought, well, a bunch of dirt, natural gas, and nuclear power plants.
It is the ultimate contrarian pivot. I mean,
Um,
you have a fund famous for defining the digital frontier, right?
exactly.
For backing the most disruptive software on Earth, suddenly taking all its chips off the table, they're rotating massive amounts of capital into the most physical, heavily regulated old-school industries imaginable.
It feels like watching a Formula One driver suddenly trade in their race car for, like, a fleet of city buses.
Yeah, that's actually a great way to put it.
So our mission for this deep dive is to figure out why. We want to understand how a high-tech venture capital philosophy is currently merging with Warren Buffett-style value investing.
Because it turns out they are betting everything on the physical, real-world constraints of artificial intelligence.
But before we jump into the core analysis, I need to share this with you. To access more advanced research, companion for modern intelligent investors, and leverage our latest Deep Values agents, welcome to download Deep Values app from App Store. To track stock market temperature, welcome to download iOS app Buffett Indicator from Apple App Store or Bubble Watch from Google Play. Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for research and entertainment purposes only and does not constitute any investment or financial advice or service. Conduct your own due diligence before making investment financial decisions.
So to really make sense of what this fund actually bought and sold, you can't just scan down a list of ticker symbols.
Right, because those are just the symptoms, aren't they?
Exactly. You have to understand the underlying economic philosophy that drives their entire decision-making process.
Okay, let's unpack this. Because we really can't make sense of this sudden, massive rotation into power generation without first looking at the pursuit of what the sources call creative monopolies over perfect competition.
Right, and this goes back to a foundational doctrine articulated in Peter Thiel's book, 0 to 1. There is this core belief here that capitalism and perfect competition are actually diametrically opposed.
Which sounds completely backwards if you've taken Economics 101.
It totally does. In school, you are taught that perfect competition is the ideal state of a market. It's a suffix.
Yeah.
But from an investment perspective, perfect competition is an absolute nightmare.
Because it just completely destroys your profit margins. I mean, if you and 10 other people are selling the exact same lemonade on the same street corner, the only way to get customers is to drop your price.
And you just keep dropping it. Under perfect competition, you have multiple participants producing entirely undifferentiated commodities. It becomes an endless race to the bottom. Everyone lowers their prices to steal market share until the price gets driven all the way down to the marginal cost of production.
Wow. So durable economic profits are just completely wiped out.
Exactly. You might survive, but you certainly do not thrive. Real value creation and long-term capital compounding requires escaping that trap entirely.
You have to build a creative monopoly.
Yes.
So perfect competition is basically like being on a really crowded treadmill. Everyone is just exhausting themselves, running as fast as they can just to stay in the exact same place.
That's a perfect analogy.
But building a creative monopoly is like stepping off that treadmill entirely to build your own private elevator. You go up, and nobody else even has the key to use it.
And to build that private elevator, you need a few structural advantages. You need proprietary technology, massive economies of scale, strong network effects, or, highly defensible brand ecosystems.
Something that acts like a moat.
Right. You are looking for an enterprise that can structurally escape competitive friction. You want robust pricing power that lasts for decades.
But finding that elevator requires differentiating between two types of progress, doesn't it?
It does. There's horizontal progress, which is going from 1 to N. That is basically just globalization, taking something that already works and copying it everywhere.
Like opening 1,000 new coffee shops.
Exactly. Then there is vertical progress, going from 0 to 1. That is creating something entirely new.
And to achieve vertical progress, you have to discover what this philosophy calls secrets.
Yes, secrets. These are fundamental, non-obvious truths about market inefficiencies or structural bottlenecks that the rest of the consensus-driven market is just completely ignoring.
So in public equities, this means finding the choke point in an industrial supply chain long before the Wall Street analysts update their quarterly earnings models.
Precisely. And this ties directly into how they view the future. The sources contrast Wall Street's standard indefinite optimism. With this fund's definite optimism.
Which honestly sounds a little arrogant at first glance.
I mean, it sounds arrogant until you look at the actual mechanics behind it. Indefinite optimism is basically the philosophy behind passive index funds.
Right, where you just buy everything.
Yeah, it assumes the market will generally drift upward over time, but you have no concrete plan for how or why. So you just scatter your capital across 500 companies and hope the aggregate tide lifts your boat.
Definite optimism is the exact opposite of that.
It really is.
Yeah.
It is the belief that the future is predictable and can be deliberately engineered through focused, high-conviction capital allocation.
You aren't guessing what the future will be. You are actively funding the specific architecture of it.
Exactly. And that leads right into the power law of capital.
Which is the mathematical reality that a tiny fraction of individual holdings is going to generate the overwhelming majority of your aggregate financial returns.
That is why a fund operating on this definite optimism framework completely avoids broad diversification. They don't want 50 mediocre positions.
They prefer highly concentrated portfolios built around massive, high-conviction macro theses.
Absolutely.
So what does this all mean for the AI boom? Did the fund just panic during a tech bubble, or are they seeing one of those structural bottlenecks the rest of the market is completely ignoring?
Well, looking at the timeline of their 13F filings, they definitely saw a bottleneck.
Because you don't just wake up one morning and decide to tear your entire portfolio down to the studs, but that is exactly what they did.
It is a truly remarkable timeline. We can trace this massive portfolio rotation through late 2025 and into early 2026.
The first major warning sign flashed in the third quarter of 2025, right?
Yes, this was the AI semiconductor divestment. The fund executed a complete 100% exit from its premier artificial intelligence holding, Nvidia.
Wait, a complete exit?
Completely. They disposed of over 500,000 shares.
That was roughly $100 million. And if I'm reading the sources right, that position used to make up 40% of their equity assets. It was a massive anchor, and they just liquidated it.
Totally liquidated. And in that same window, they slashed their Tesla holdings by 76%.
Wow.
And interestingly, they also fully divested an initial stake they had in Vistracore, which is a power company we'll definitely be coming back to.
So what was the rationale there?
There's a classic bubble warning. The fund's management cautioned that hardware valuations had detached from near-term economic productivity.
So they were drawing explicit analogies to the late 1990s tech cycle.
Exactly. Just like when companies were laying thousands of miles of fiber optic cable long before there was enough internet traffic to actually justify the cost.
You know, everyone likes to say Nvidia is selling the picks and shovels for the AI gold rush, but I guess this fund realized that once everyone has a pickaxe, you stop selling pickaxes.
That's a great point.
So they take all that cash from Nvidia and Tesla, they park it temporarily in mega caps like Apple and Microsoft, but then we hit the end of 2025 and early 2026, and this is the part of the filing that genuinely dropped my jaw.
Total equity neutralization.
Yes. They took the aggressive step of liquidating everything else.
The remaining Apple, Microsoft, and Tesla positions were completely sold off. For 2 consecutive quarters, the fund reported literally $0 in 13F equity assets.
Going to zero equities in the middle of the biggest tech bull run in history is either the most genius move of the decade or the kind of thing that gets a fund manager's access badge permanently deactivated.
It takes incredible conviction. They just sat on the sidelines in cash and short duration equivalents. They kept their powder dry.
They insulated themselves from any market multiple contractions.
Right, and they just waited for the real bottleneck to emerge. Which brings us to the second quarter of 2026, the energy rebuild.
So they finally come back to the market.
They rebuilt the public equity book to over $400 million, but the composition was entirely different.
Roughly $300 million of that capital was aggressively concentrated across regulated electric utilities, merchant power generators, and advanced nuclear reactor development.
Plus, a massive anchor position in Amazon. They put around $120 million just into Amazon.
What's fascinating here is the secret they discovered, to use Thiel's terminology.
The underlying thesis of this massive pivot is the realization that the primary constraint on digital intelligence has officially shifted.
It is no longer about semiconductor availability.
Exactly. Getting enough silicon chips is no longer the problem.
Okay.
The true bottleneck is the continuous physical delivery of baseload electrical power.
So the game is no longer about silicon, it's about electrons.
Yes.
It is like Imagine a company spending billions to build a massive fleet of million-dollar next-generation sports cars.
Okay, I'm with you.
These cars are absolute engineering marvels, but right as they are rolling off the assembly line, everyone looks around and realizes nobody remembered to pave the roads or build any gas stations.
Oh, wow.
You
Yeah.
have all this immense horsepower and absolutely nowhere to run it. That is the AI industry right now. The data centers are the sports cars, and the electrical grid is the unpaved road.
That's exactly what's happening. Advanced data center clusters require gigawatts of uninterrupted 24/7 baseload electricity.
Right. You can't run an AI training model on solar power that cuts out the second it gets cloudy.
And you can't just plug a new gigawatt data center into the local grid either. Municipal transmission networks have multi-year interconnection backlogs.
So if you want to connect a new massive load to the grid today, you might be waiting in a queue until, what, 2030?
Easily 2030. Furthermore, licensing conventional power plants takes incredibly long regulatory cycles. So operational existing baseload generation assets have suddenly become the ultimate strategic economic bottleneck.
Okay, recognizing the power bottleneck is one thing. That is a brilliant macro thesis. But how do the specific companies they chose fit into a sustainable, risk-averse investment framework?
Well, this is where it gets really interesting.
Because this is where the venture capital mindset of Peter Thiel suddenly crosses over with Warren Buffett. They start applying a strict value investing lens to these physical constraints.
Right. When you look at classic value investing, the Graham and Dodd criteria refined by Buffett, you are looking for a few specific things.
You want a clear, understandable business model.
You want a wide economic moat protecting the business from competitors. You want high returns on invested capital, substantial free cash flow, what Buffett calls owner earnings.
And a robust balance sheet offering a clear margin of safety.
Exactly. So let's look at VistraCore, ticker VST. This is a 14.1% portfolio weight for the fund.
And as you mentioned earlier, they actually bought back in after selling it.
They did. Vistra operates as an integrated competitive power generator and retail energy supplier. They have an asset fleet of approximately 44 gigawatts.
That spans natural gas, nuclear, coal, and battery storage, right?
Yes. And they have a pending acquisition that will add another 5.5 gigawatts of highly efficient natural gas generation.
But the real magic here is their moat. Their moat is essentially just physical reality.
The moat rests on physical asset scarcity and extreme regulatory barriers to entry. You cannot just spin up a new nuclear power plant in your garage like a software app.
No, definitely not.
Constructing new baseload nuclear or thermal generation capacity in the U.S. requires years of environmental permitting, immense supply chain lead times for specialized parts, and massive, massive capital expenditure.
And Vistra already operates zero-carbon baseload facilities, like the Comanche Peak Nuclear Station.
Because they already have these assets operational, they possess incredible pricing leverage.
Because the big tech companies, the hyperscalers like Microsoft, Google, and Amazon, are absolutely desperate for that power to run their AI computing clusters.
Yes.
So they're going to Vistra and locking into long-term power purchase agreements, or PPAs. Vistra isn't just selling power day by day on a volatile open market.
No, they are locking these desperate AI companies into multi-decade inflation-proof contracts. They're basically turning a fluctuating commodity into a guaranteed subscription-like revenue stream.
And the financials completely reflect that transformation. Vistra is generating incredible cash flow.
They projected full-year 2026 adjusted free cash flow of roughly $4 to $4.7 billion.
That is staggering.
And they are aggressively prioritizing shareholder returns, repurchasing hundreds of millions of dollars of their own common stock. Their credit quality is rising too. They were upgraded to investment grade by both Fitch and S&P.
Which lowers their borrowing costs and unlocks even more financial flexibility to expand.
Exactly.
So Vistra is the cash cow generating the raw power, but then you look at the other chunk of the portfolio, the regulated utilities. American Electric Power, DTE Energy, CMS Energy, First Energy.
These make up another 10 to 11.5% each.
These companies don't necessarily generate all the power they own the transmission lines. And to me, this fits the Buffett model flawlessly.
It really does.
These utilities have state-sanctioned geographic monopolies. It is legally and economically impossible for a competitor to come in and build a duplicate high-voltage interstate transmission grid right next to yours.
It is a protected franchise monopoly, and they sit right in the path of the AI build-out. Look at American Electric Power, AEP.
Right.
They operate the largest electricity transmission system in the U.S. AEP Ohio recently joined a federal partnership for a planned 10-gigawatt AI data center complex.
And to make that happen, they need a $4.2 billion transmission build-out.
Exactly.
And the beauty of regulated utility rate making is that when they spend that $4.2 billion to build new lines, it expands their regulated rate base.
Yes, the state utility commissions guarantee them a specific return on equity on that invested capital.
It is honestly like owning the only toll bridge right outside the hottest nightclub in the world. It doesn't matter which DJ is playing inside. It doesn't matter which tech company has the best AI algorithm. If they want to get their data to the club, they have to pay your toll.
That's a perfect way to look at it. These utility holdings offer defensive earnings stability. They are low beta, meaning they don't swing wildly with the stock market, and they offer deeply reliable cash generation.
They function basically as bond proxies, but with inflation-protected growth baked right into their rate base.
Exactly.
Okay, I'm totally with you on Amazon, Vistra, and the utilities. They fit perfectly into the moat and cash flow value framework. But wait a second.
What is it?
I'm looking at the notes on X Energy in this portfolio, ticker XE. You cannot tell me this is a value play.
X Energy.
They generated something like $40 million in revenue. They have negative operating cash flow. They are requiring massive capital outlays just to build fuel manufacturing facilities. And their near-term survival basically relies on $1 billion in federal funding from the Department of Energy. This is a cash furnace. Warren Buffett wouldn't touch this with a 10-foot pole.
He absolutely wouldn't. And if you run X Energy through a traditional Graham and Dodd value screener, it fails catastrophically.
It has zero discernible margin of safety based on current cash generation.
None at all.
Then why on earth are they dedicating capital to it?
Because this roughly 1% allocation is the classic Thielian venture play. This is the 0-to-1 bet hiding inside a portfolio of utilities.
Oh, I see.
X Energy is an advanced nuclear reactor and fuel design company. They specialize in small modular reactors, or SMRs.
SMRs, right.
Specifically, they're developing a high-temperature gas-cooled reactor. And crucially, they manufacture a proprietary uranium fuel called Trio-X, which is physically engineered to resist meltdown under extreme temperatures.
Ah, okay. So the moat isn't current cash flow. The moat is deep intellectual property.
Yes, intellectual property combined with massive regulatory licensing barriers. Getting a new reactor design approved by the Nuclear Regulatory Commission requires years of painstaking engineering validation.
But once you have it, nobody can easily replicate it.
Exactly. They have already secured a deployment partnership with Amazon and signed long-term fuel fabrication agreements. It is a highly speculative, high-upside investment on the structural shift toward modular, decentralized nuclear power.
That makes perfect sense. It's a small, calculated bet with asymmetrical upside. If SMRs become the standard for powering localized data centers, that intellectual property is worth billions.
Easily.
And speaking of outliers, there's one more here. Vist Energy, ticker VIST. This is an upstream oil and gas exploration company operating down in Argentina.
It's about a 2.1% allocation.
Now, as a commodity producer, they have absolutely zero structural pricing power. They are totally exposed to the boom and bust of global oil prices, plus, all the macroeconomic volatility of operating in Latin America.
True, it completely lacks the impenetrable moat of a regulated U.S. utility. But the business reality here is about operational efficiency.
How so?
Vista Energy is drilling so cheaply in the Vaca Muerta Basin that even if global oil prices completely tank, they are still pulling cash out of the ground.
Really?
Yeah, they traded incredibly low cash flow multiples. They command a low-cost production footprint with very favorable lifting costs per barrel.
So even during moderate commodity downturns, it generates positive free cash flow.
Exactly.
Yeah.
It provides a high, immediate cash yield to balance out a portfolio that is otherwise making very long-duration bets on infrastructure.
Here's where it gets really interesting for you listening. When you zoom out and look at this entire portfolio rotation, from dumping Nvidia to buying nuclear plants and toll bridge utilities, you are seeing a masterclass in anticipating the second and third order implications of AI.
It's phenomenal foresight.
The initial phase of generative AI was all about hardware CapEx. That was 2023 to 2025. Capital flooded into semiconductor designers because chip demand vastly outpaced fabrication capacity.
But computing power is ultimately physically bounded by electrical current.
Right. The macro migration we're seeing here is the realization that the primary constraint has moved from silicon chips to physical energy bottlenecks.
If we connect this to the bigger picture, it really comes down to the difference in capital durability between these two sectors.
Capital durability.
Yeah, think about the mechanics of semiconductor hardware design. It is highly volatile. It is exposed to rapid product obsolescence.
Because an AI chip you design today might be completely obsolete in 2 years when a competitor shrinks the transistor architecture.
Exactly. You have heavy customer concentration, and you are constantly at risk of cyclical supply gluts once new fabrication plants finally come online.
Right, eventually TSMC or Intel builds enough factories to make all the chips everyone wants, the scarcity vanishes, and the profit margins completely compress.
And the treadmill of perfect competition starts up all over again.
Wow.
But utility cash flow compounding is an entirely different beast. Power producers with firm nuclear and natural gas capacity are converting this surging, desperate AI demand into multi-decade agreements.
You don't just replace a power plant in 2 years.
No, you don't. That physical infrastructure offers long-term compounding that semiconductors simply cannot match. You lock in those inflation-linked contracts, you lower your structural cost of capital over time, and you consistently use the cash to retire common shares.
It is a profoundly more durable foundation for long-term capital preservation and growth.
It really is.
It's the ultimate reality check for the digital age. We talk about the cloud like it's this magical, ethereal thing.
It's not.
No, you can't write all the code you want in the cloud, but the cloud still runs on a physical machine in a physical building, and that machine needs to be plugged into a wall.
Exactly.
And that leaves me with this final, honestly somewhat unsettling thought for you to mull over. We've seen how computing power is absolutely bound by electricity.
Right.
We've seen how domestic transmission grids and nuclear facilities are becoming the new gold mines for intelligent investors. But what does this actually mean for global geopolitics over the next decade?
That is the million-dollar question.
If a nation's absolute supremacy in artificial intelligence, its economic and military edge is entirely dictated by the physical constraints of its domestic power grid, do local regional utility companies eventually become matters of ultimate national security?
It's very possible.
Could a boring regional electric utility in Ohio or Texas find itself more fiercely protected by the federal government than the cutting-edge algorithms themselves?
It really makes you wonder.
It makes you wonder if selling those AI chips for power plants wasn't just a brilliant financial pivot, but a bet on the true architecture of future global power. Thanks for joining us on this deep dive. See you next time.